You don't lose money because of bad luck. Why unlucky is the most expensive lie investors tell themselves. Cold open, the easiest lie. Every investor who ever went broke had a perfect explanation. Bad timing, bad luck, wrong market. Almost none of them were unlucky. 2. Reality shock, luck is the alibi. Most investors genuinely believe this story. I did everything right, I just got unlucky. They say it calmly, they say it convincingly. They often believe it completely because bad luck is the most comfortable explanation the human brain has ever invented. It does three things at once. It removes responsibility, it protects self-image, it ends further questioning. And that combination is lethal in markets. Here is the uncomfortable truth seasoned investors eventually learn the hard way. Markets do not bankrupt people through bad luck. They bankrupt people through unexamined behavior under uncertainty. Luck exists, randomness exists, volatility exists, but none of them are sufficient explanations for repeated losses. If bad luck were the cause, outcomes would be evenly distributed. Some people would randomly lose, some would randomly win. But that's not what we observe. We observe the same people losing money, repeatedly, predictably, across cycles, assets, and narratives. Luck does not behave like that. Patterns do. And markets are ruthless pattern detectors. They do not care about your intentions. They do not care about your effort. They do not care about your explanations. They only reveal consequences. So if losses keep appearing in the same portfolios, in the same emotional moments, after the same types of decisions, this is not randomness. This is structure. 3. Framework model, the luck attribution trap. Let's dismantle the myth properly. The core error. Most investors confuse uncertainty with unfairness. When outcomes are painful and unclear, the brain looks for relief, and the fastest relief is external attribution. It wasn't my process. It wasn't my sizing. It wasn't my timing discipline. It was just unlucky. This is not stupidity. It is evolution. Humans evolved to survive emotionally, not probabilistically. The model, outcome, emotion, explanation. Here is the invisible loop that destroys capital. Outcome, loss occurs. Emotion, pain plus threat to identity. Explanation, externalize cause to preserve self-image. Once this loop completes, learning stops. And what stops learning guarantees repetition. Where bad luck actually comes from. In professional investing, we define luck very narrowly. Luck equals variance you did not price into your decision. Retail investors redefine it emotionally. Luck equals outcome I did not emotionally prepare for. Those are not the same thing. Let's break this down with precision. When a single position can materially damage your portfolio, the loss is not unlucky. It is oversized risk. Markets didn't attack you. You exposed yourself. If a position can cause emotional panic, it was already too large. Pain does not come from price movement. It comes from excessive exposure to uncertainty. Calling that bad luck is like calling gravity unlucky after jumping off a roof. Most unlucky investors were not wrong. They were early without endurance. They entered with a long-term narrative and managed it with short-term emotions. The market didn't betray them. Their time-frame schizophrenia did. They said, this is a 3 to 5 year investment, but they behaved like, I need confirmation by next week. When the market failed to validate them quickly, they labeled it misfortune instead of mismatch. Retail investors think in stories. Markets operate in distributions. A trade can be logically sound, fundamentally correct, structurally aligned, and still lose money. That does not make it unlucky. It makes it one outcome inside a probability range. Professionals lose trades all the time. They don't call it bad luck. They call it expected variance. If losing a trade surprises you, you did not understand the distribution you entered. The moment most investors enter a position is often the moment risk is highest. Why? Because confidence peaks late, narratives peak late, social validation peaks late. By the time something feels obvious, most of the asymmetric upside is already gone. The loss that follows is then framed as misfortune, but it wasn't random, it was late-stage certainty. Let the following question land. If it wasn't bad luck, what pattern keeps repeating in my decisions? Do not answer it yet. Just notice the discomfort. That discomfort is where real learning lives. Here's the insight that permanently changes how serious investors think. You don't lose money because of bad luck. You lose money because you took risks you didn't fully acknowledge, size, or emotionally accept. Luck is not the cause. Luck is the label applied after responsibility is removed. The market did not surprise you. You surprised yourself. You overestimated what you knew. You underestimated what you didn't. And the bill always arrives afterward, not as punishment, not as injustice, but as feedback. Markets don't care if you call it unlucky. They care whether you adjust the structure that produced it. There is no motivation here, no encouragement, no promise that it gets easier. Only this: if you keep losing money and you keep calling it bad luck, you are not unlucky. You are avoiding the only question that matters. What part of my decision-making process am I protecting from scrutiny? There's a pattern every veteran investor eventually notices, not in charts, not in indicators, not in macro cycles, but in people. Across bull markets and bear markets, across stocks, crypto, real estate, startups, the same group keeps losing money. They change strategies. They change assets. They change narratives, yet the outcome barely changes. And here's the disturbing part. They don't see themselves as reckless. They don't see themselves as emotional. They see themselves as unlucky. That belief becomes identity. Markets just never work for me. I always enter at the wrong time. Whenever I buy, it dunks. This is not randomness. This is a behavioral signature. Markets are not casinos handing out random misfortune. They are mirrors. They reflect back how you deal with uncertainty, delay, pain, and ambiguity. And mirrors do not lie. They repeat. Let's formalize this. Repeated losses do not come from bad luck. They come from structural fragility. The loss architecture model. Every loss-producing investor shares at least one of these 5 structural weaknesses. 1. Fragile exposure. A portfolio is fragile when one position matters too much. One narrative matters too much. One outcome defines emotional stability. Fragility means small surprises cause large damage. In fragile systems, randomness feels hostile. But randomness is neutral. It is fragility that turns volatility into catastrophe. Robust investors assume volatility. Fragile investors feel betrayed by it. 2. Emotional leverage. This is leverage no broker reports. Emotional leverage exists when self-worth is tied to outcomes, intelligence is tied to being right, identity is tied to prediction. When a position fails, the loss is not financial. It is personal, so the brain seeks defense. And bad luck becomes psychological insurance. If you need luck to explain losses, you are emotionally over-leveraged. 3. Decision compression. Under uncertainty, amateurs compress decisions. They enter too fast, exit too fast, resize too late. They act under narrative pressure, not structural clarity. Professionals expand time. They slow entry. They predefine exit. They reduce decision load under stress. Luck dominates compressed decisions. Process dominates space decisions. Most investors obsess over upside. They calculate targets. They imagine gains. They screenshot potential profits, but they vaguely gesture at downside. I'll manage risk if it goes wrong. This is not risk management. This is hope with better vocabulary. Unpriced downside always reappears as bad luck. The most dangerous weakness. After a loss, the investor explains why it was inevitable. News was unexpected. Market was irrational. Whales manipulated price. Macro conditions changed. Each explanation feels intelligent. Each explanation blocks learning. Because none of them examine decision quality before outcome. Markets don't care how good your explanation sounds afterward. They care what you prepared beforehand. Ask the viewer nothing. Just let this sentence sit. If luck explains my losses, what explains the people who survive the same market without drama? Here's something retail investors rarely understand. Professional investors experience more randomness than amateurs. They trade larger size. They operate under tighter constraints. They face real career risk. Yet they almost never say, "I was unlucky." Why? Because in professional environments, blaming luck is a signal of incompetence, not because luck doesn't exist, but because your job is to design systems that survive it. If a fund manager blamed luck consistently, capital would be pulled. Because luck is not controllable, but exposure to it is. This is the insight that permanently reframes everything. Luck is not an external force. It is the name we give to risk we failed to map. Once you truly understand this, you cannot go back to old thinking. Every loss becomes diagnostic. Not, "Why did this happen to me?" but "What assumption did I quietly make that reality rejected?" The market didn't attack you. It revealed something. And revelation is only painful when ego blocks interpretation. How veteran investors eliminate luck from their vocabulary is not by predicting better, but by designing better decision environments. Here's what changes in their approach and mindset compared to average or novice investors. They size positions so that the outcomes are survivable no matter what. This ensures they stay in the game regardless of unexpected market moves or sudden downturns. Survivability is their first priority when making investment decisions. They expect drawdowns before entries. Instead of being surprised by losses, they anticipate setbacks as a natural part of investing. This expectation helps them respond calmly and avoid emotional reactions when downturns occur in the markets. They define failure before commitment. Before entering any position, they know exactly what will signal the need to exit. This discipline prevents them from lingering and losing trades and helps maintain objectivity in their decision-making process. They diversify not just across assets, but error types. By spreading risks related to different types of mistakes, they avoid being exposed to a single point of failure. This approach reduces the likelihood that any one error will have a devastating impact. They separate identity from outcomes. Their self-worth does not depend on winning or losing in the markets. This separation allows for clearer judgment and less emotional attachment to specific results, making them more adaptable. When losses occur, and they always do, they feel boring. Boring losses do not need excuses, only adjustments. Veteran investors don't waste energy rationalizing losses. Instead, they methodically learn from them and make the necessary changes to their strategy. If bad luck is responsible for your losses, then skill cannot explain anyone else's success. You cannot have it both ways. Either markets reward structure over time, or everything is random and meaningless. If you believe the latter, you should not be investing, because investing is the discipline of surviving randomness, not complaining about it. Successful investors adapt to uncertainty rather than fighting against the reality of unpredictable outcomes. There is no call to action, no advice to follow, no strategy to copy, only a choice. You can keep losing money and calling it bad luck, or you can accept the harder truth. Markets are not unfair. They are honest, and honesty is brutal to those who don't listen.